Hi, welcome. You're watching BQ Prime. I'm Tamanna Inamdar, and we're going through a slew of quarterly numbers that have come in this season. Today, we're talking about Westlife Food World. They are, of course, the company that runs McDonald's in the south and the western part of this country. And Akshay Jatia, Executive Director, is with me today. Before I start the conversation, and very welcome to you, Mr. Jatia. Great to have you on the show. But before we start the Q&A, let me just go through the numbers consolidated year on year. So revenues have been up about 7% at 614 crores, EBITDA up 2.38% at 98 crores, margins at 15.97%, slight slide in margins, and reported PAT was down about 29%. At 22 crores versus 31.53 crores, below estimates as well. So let's begin with that point. Has this been a tough quarter because of input prices? I mean, this was also the quarter, Mr. Jatia, which was dominated in the news cycle by the prices of tomatoes, very famously. Some franchisees also stopped serving tomatoes. Is that what we're seeing, the tomato effect?
So thank you for having me here. It's a pleasure to speak to you. I think, we've always been saying, you'll have ups and downs in quarters. Actually, what's going on in the macro environment is there is a softening in terms of, people going out to eat for multiple reasons. Number one, we've had a euphoric year behind us in terms of a lot of consumer spending. You are seeing, fasting seasons, seasonality coming back into play. So we had an extended period of Shravan and Shraadh, which has overall impacted both Indian eat out, which is informal eat out for us, and the Western fast food category. So both have degrown, but at the same time, we have captured share, basis the market track that we cover and kind of discuss internally. So we're very enthused about that. Number two, yes, same-store sales growth has still been positive. We feel it's differentiated in a quarter where retail overall is seeing, pressure. And lastly, we've done a great job on profitability. In fact, you'll see our gross margin has actually improved, and it's around 70% highest ever. And you've seen a little bit of a dip in EBITDA margin because number one, operating leverage didn't play out exactly like how it usually does because of the seasonality of the quarter. And secondly, we added a large number of stores to the base. So you see some of those, payroll costs hitting cost line items while revenue is picking up. So, this is what typically happens in a year, when you add a large number of stores, which we will be doing.
So if I may come in, I'm still not very clear. What has been the trend or the concern? Is it less demand, less consumers walking in to buy those meals, or is it higher input costs, a mix of the both, or neither? What exactly is the reason?
So like I said, it is because there's a softening environment. You are seeing both informal eating out as well as Western fast food as categories declining. So you are seeing less customers going out and spending less money. However, as McDonald's, we've captured more share. So obviously sales didn't, grow as much as they have in the past. However, we've still been in positive, high single-digit territory in terms of total sales growth. And as a result, you have seen a little bit of an impact in profitability. I don't think it's anything, to worry about. It's not notable. We're still in the range of, around 12 to 13% EBITDA margin pre-Ind AS, which is where we've always been. You've just seen kind of lower comparable sales growth. And again, like I said, it's seasonal, and we expect this to bounce back.
So Shraadh was a few days, and I believe, and I saw that in your investor presentation, you also had a Shraadh menu. So that didn't really help? Did Shraadh have such a big impact? Or is it a larger trend that you're seeing also because, and you talked about macroeconomic conditions, I'm trying to understand if this is a larger trend you're seeing in terms of hit on discretionary spends of consumers?
So I'm actually speaking more about the Shravan period, which was the extended fasting period.
Okay.
Shraadh is, something that also came to affect this quarter. And again, customers behave differently this year versus last year. last year you saw customers going out regardless because they hadn't been out for a long period of time. I wouldn't have called it kind of revenge spending, but it's just that customers were kind of ignoring the usual seasonal behavior. And today and this year, we are seeing that come back. However, like you said, we did have a no onion, no garlic menu, which we continue to have in our restaurants. And it's actually resonated very well with our customers. And they've been delighted, and those products do well.
Okay. And on the input cost side, have there been any kind of pressures over there? Or has that now eased out?
No, actually, we have long-term relationships. We have multiple levers to manage gross margin. And like I said, our gross margin has actually increased. And as a result, input cost is not the reason as to why we saw pressure on profitability.
Okay. Are you expecting a recovery of that demand, which you saw sort of softening in Q2? And on what basis are you expecting that recovery?
So while I won't make forward-looking statements, but we are optimistic about Q3, which is a festive period and usually a very good period for retailers as well as Western fast food and QSRs like ourselves. So we definitely have all the strategic levers in place to bring back customers, to increase their frequency and retain them. So we're very excited about the quarter that's coming up. But what we are most committed to is our long-term vision of 2027, which is our long-term plan where we have clearly laid out that we want to be in high single-digit SSSG, 600 odd stores, and increase profitability to around 18 to 20% post-Ind AS. So those are very good goals to have. It means doubling sales, which means high growth in the next few years to come.
Right. Your operating EBITDA margins were also lower due to higher G&A costs. Can you elaborate on that?
So while year on year it may look like it was higher, I think sequentially we're around the level that we have been last quarter, and obviously it's a result of number one, we have staffed for the right position as we're going through this new phase of growth. We have obviously skilled up in terms of a lot of skills that are required both on the technology side, digital side, strategy side. And lastly, obviously, there was a period of 2 years where, variable incentives, were not triggering. We've definitely obviously corrected for that last year as well. But, we're continuing to ensure that we incentivize our talent to stay with us and help us grow basis our plan for the next few years.
Okay. You've added 9 new restaurants this quarter. Your aim is to add a total of 40 to 45 stores by the end of this financial year. Is that pace expected to pick up in the second half? And did you see that pace of new store additions slow down in Q2, or is this as planned?
No, definitely will pick up. This is how we historically kind of manage our inventory because our cycle times are longer. We're very particular about location. We're focusing more on drive-throughs, which are larger pieces of land to secure. So as a result, our cycle time, for the real estate process is roughly around 18 months. And what you do see is in half two, we do pick up the pace in terms of openings. So you will see us pick that up and deliver the 40 to 45 stores that we've committed in terms of our expansion plan.
All right. Give us some idea about, the plan going forward into what you said is the festive season. You're expecting higher demand. What is the strategy here? Is there going to be a pricing play? What really can you add in terms of what your plan is to cover up for the rest of the financial year for H2?
So, again, quarter on quarter, we have different initiatives. We have a calendar that's planned out at the beginning of the year. What we're most excited to share is that, number one, we had anyway launched our extra value meal of 179 rupees last quarter. And that will continue to play out as we, stand for value for money, which means that we'll offer not only a great price, but also a great set of offerings. Secondly, we are doing a cheese festival, which will play across all price points. Not only the premium price point, which is our McCheese kind of flagship product that's done really well over the last few years after we launched it. And this cheese festival, again, is something that will bring excitement during the festive period, as well as kind of new sensibilities for customers, because we've launched a limited time burger as well, which is an Italian kind of burger, which already has gotten overwhelming response. And we're also doing stuff around desserts and McCafe, as we usually do during this festive period. So we feel that all this put together and customers also going out during the festive period will allow us to capitalize for Q3. And Q4 similarly will be planned to ensure that we deliver on our plans for the year.
No price cuts on the anvil or larger offerings. Some competitors in the space are trying to lure customers in with better offers in terms of pricing. None of that?
So we don't really believe in pricing wars or kind of following the competition. However, we have a very special offering, which is our McDonald's application, where we have a bunch of offers that continue to rotate, promotions which give excitement to our customers. And we've seen huge traction in terms of the uptick over there. We in fact have different meal combinations at substantial value, more than what we offer even in our restaurants on this McDonald's app. And as a result, we stay competitive, but at the same time, we're not following some kind of price war where we just kind of lower prices because the competition is doing so. So I think that's how we stand for value for money, and we always have. And we're excited, to see how customers come back to our restaurants.
All right. Thank you so much, Jatia, for speaking with us, the management of Westlife there, talking about a quarter gone by, which has seen a surprise dip in profits due to softening demands. They're hoping the demand will pick up next quarter with the festive season around the corner. Thank you for watching.